Elliott wave. We're going to introduce the basics of it. We're going to be talking about the market psychology behind it. We're going to be talking about the 3 rules, and there are only 3 rules with it. There are quite a number of guidelines. Now, the guidelines are interchangeable. That's where a lot of the problems come with Elliott wave. If one person sees something and someone else sees something else, that's a guideline that's being tested. And a guideline is exactly that. It's a guideline. It's not a rule. The rules can't be broken. They're black and white. They cannot be broken. But guidelines, it's more to do with the individual. But we've got some simple guidelines. You'll note after you've seen this presentation that we use them time again. We don't deviate from our simple guidelines at any way, shape or form. We're going to look at the look and feel of the charts because at the end of the day, Elliott wave is a discretionary technique. Okay, it is discretionary. It's not scientific, and what can look and feel to one person can look and feel to something else. We're going to look at the law of alternation. We're also going to look at end of wave analysis, which again, you'll see some things that we use in the Chartist, and very important, and I think this is probably the most important part of Elliott wave and potentially tonight's discussion, is identifying corrections. And the reason I say that is because at the end of the day, what we want to do when we trade, we want to trade the impulses. And in order to trade the impulses, we have to identify the corrections. If we can identify the correction, we can trade the impulse, and that's what's very, very important. And then lastly, I'm going to show you a few little magic tricks using raw charts. What I want to start with here is the market psychology behind Elliott wave. Elliott wave is not about forecasting the future. We are looking for repeatable patterns, and those repeatable patterns have some kind of probable outcome, but more importantly, a repeatable pattern you can confirm when you are right and when you are wrong. You know how to enter, you know where to put your protective stock, you know when you're wrong. And that's the important thing with Elliott waves. They are no different to any other pattern, whether it be a triangle, a head or shoulders, or a flag, or whatever you want to do in technical analysis. At the end of the day, Elliott wave is simply a comfortable way to be involved in the market. In some respects, I think it's a very, very important way to be involved in the market because we can capture impulses at a very, very early stage. But at the end of the day, patterns, regardless of the kind of pattern, comes from one thing, and that's the psychology of the market participants. And what I want you to think about as we go through tonight's presentation and as you look at the charts on an ongoing basis within the Chartist is this, that the market moves 3 steps forward, 2 steps back, and it does so in an impulse correction, impulse correction, impulse correction. You know, that's all that goes on. So let's just go through those 2 market phases. Remember, those 2 market phases are pretty simple. Impulsive, and that is denoted by numbers, and corrective, which is listed with letters. Okay, so an impulsive movement is a powerful move that impels the market forward. These are the moves we want to capture. They're smooth, they're clean, they are the trends. These are the moves we want to capture, the impulsive moves. So we always label them with the numbers. The corrections, they're counter trend interruptions within the bigger trend. They tend to be very choppy, very nasty, overlapping price action, and it's these corrective movements that really, 1, you don't want to trade, but 2, you want to be able to interpret to some degree because, as I said, after every correction you get an impulse. So if you can understand where or how a correction unfolds, and we're going to look at this, if you can understand how a correction unfolds, then you can better understand when and where an impulse will start. And if that's what we're doing, i.e. trading the impulses, then understanding where a correction will complete, you'll understand where an impulse will start and you'll be in a better position to trade it. So let's move on. Here is a very, very typical Elliott wave pattern. Remember, we're talking very simplistic terms here today, and what we want to look at is an impulsive movement. So we start from this point, and we're going to be talking about the psychology of it all. So we start from this point down here, move up, retrace, move up again, retrace, move up again in 5 waves. Then we trace A, B, C again. Okay, so at the end of the day, not every chart is going to fulfill an Elliott wave pattern. That's all there is to it. If you go and try and fit an Elliott wave pattern to every single chart, you're going to be very, very disappointed. So what we have here at the moment is a very simplistic view, but if you cannot see an Elliott wave, so we have the very simple Elliott wave pattern right here, 5 waves up, 3 waves back down again, and off we go to the upside. So let's just move to the next pattern right here. Elliott wave is a fractal, which means every individual wave contains their own set of waves. So in this particular situation, we have a wave 1, but that will contain 5 smaller degree waves. A wave 2 will contain 3 smaller degree waves. So that's what's going on with a fractal. Again, with wave 3 will contain smaller waves, wave 4 will contain smaller waves, wave 5 will contain smaller waves. That's the way it occurs. Now the important thing to understand with Elliott wave is that every impulsive wave, that is waves 1, 3, 5, A and C, will all contain 5 waves. All corrective waves, which are waves 2, 4 and B, will generally contain 3 waves. Now when we look at end of day charts, which we will be doing tonight, sometimes it's impossible to see those distinctions. But I'll show you how to pick them up, because sometimes those distinctions will actually occur on an intraday basis. So what a lot of people tend to do, and I don't, but a lot of people do, is they will look at an end-of-day chart for the bigger wave counts and they will break it down into the smaller degree patterns using intraday charts. And when we go down to intraday charts, the patterns stand out a lot more. So, bottom line is Elliott wave is a fractal. In other words, one pattern or one time frame is exactly the same as a different pattern on a different time frame. It doesn't matter if that time frame is smaller or larger, the patterns will exist. If we break it down again, you can see what happens here. So here's our core pattern, 1, 2, 3, 4, 5, A, B, C. But if we break it down to the smaller degree pattern, we've got 5 waves up to 1, 3 waves down to 3, 5, 3, 5, 3. And in fact, if we break them down even further, we've got 21 waves up, 13 waves down, 21 waves up, 13 waves down, 21, 21, 13, 21. So you can see every impulsive wave, that's 1, 3, 5, A and B, A and C, are all 21 waves, and every corrective wave, which is 2, 4 and B, are all 13 waves. The other thing you will notice is the Fibonacci numbers. All these are Fibonacci numbers. So as I said, they may not stand out, and usually they will not stand out on an end-of-day chart, but if you break it down to the smaller degree patterns, you will generally find that you will see these waves. Is it important? No, it's not important, because as I said, what we're going to start to see is how you can define very, very simply, and when we get into the raw charts at the end of this session, how we define those waves is going to stand out to you pretty easily. So, couple of questions just come in. Can we expect to see market psychology showing up in mid-caps such as Ramelius and Arafura, or too small? Shane, at the end of the day, all price action is driven by fear and greed. Okay, so essentially it is the psychology of the users. The $64 million question is how many users or participants are in that particular stock. The ones you've mentioned, look, there are a lot of participants, and you have to weigh more onto the psychology when there are more participants. When there's less participants, if we go way out the end of the curve out there, when you're getting little tiny micro caps, you can't really weigh a great deal onto the chart patterns that are occurring out that way, simply because there's not enough participants to really give it credibility. So the more participants, the more volume, the more turnover, then the more valid the patterns are. So where we are right now is Elliott wave is a fractal pattern, and those fractals are made up of smaller patterns exactly the same. So what I want to talk about now is a bit more in depth of the psychology behind those particular wave structures. So bear with me as I run through these. I don't like to read off the screen, but I'm going to have to do it here because I simply can't remember myself. So let's start with the beginning of a wave. How does it happen? How does the market turn? Usually a market will start to turn when there is an overreaction to good news or bad news. It doesn't matter if it's good or bad. Usually you will find if there's excessive bad news, the market is ready to turn higher. If there's excessive good news, the market is ready to turn lower. So a new uptrend or an upward wave pattern will start with bad news, and quite probably some kind of a blow-off low pattern or some kind of a pattern that will exhibit a reaction or an overreaction to news. We're going to have a look at some of those patterns a little bit tonight. A new downward wave pattern will start with good news and possibly a blow-off high, although buyer exhaustion is more likely to cause a new wave pattern. Now, it's a little bit different with a bull market than it is a bear market, i.e. a bear market turning into a new bull or a bull turning into a new bear. A little bit different simply because the market participants tend to be buy only rather than sell only. Okay, so what happens is participants will tend to react emotionally a lot more when share prices are falling rather than on the upside. So as a result, we get these V-shaped bottoms where the prices fall and they jump up very, very quickly, very, very aggressively. So bear market rallies, nasty, nasty pieces of work. But when we get a market top, they tend to roll over slowly. So what we want to look for to see the end of a pattern is really, at the end of the day, extreme volume events, especially when a new bullish wave pattern could form. And we're going to show you a couple of examples of these as we go through. So when we get to wave one, usually news continue, and I'm talking about a bull market here, okay? So we're talking about an upward 5-wave structure. So wave one, news remains mostly negative. Open interest in put options is very, very high and will usually be a low volume rally. Usually be a low volume rally and contain minor short squeeze in a new upward movement. The market at this stage is still not yet convinced that a new uptrend is underway and will be more inclined to wait until the downtrend continues. So usually we tend to get very short, sharp, short squeezes, and that can be quite nasty to trade. But at the end of the day, people aren't convinced, and this is when we start to think about this higher swing low pattern that we've talked about before. So let's go on to wave two. And everybody assumes that the market will continue to trend lower because we are still making lower lows and lower highs. And in classic technical analysis, we still have a downtrend in place. So until that changes, everyone assumes that the downtrend will resume. So at this stage, news is still negative. Remember, the stock market tells you what's going to happen in advance, okay? The stock market leads the fundamentals. So news at this stage in waves two is still very negative. Latecomers are getting the news and they're entering the market. Of course, they're entering short. But volume will tend to be declining as wave two unfolds, and that's a very, very important function. If volume is declining into wave two and there is background volume strength at the start or the bottom, then potentially we have a very, very good reason to start getting bullish. So a low volume decline into wave two is very, very important. The last thing to understand is the wave two tends to be deeper simply because people believe the prices are still going lower. They still believe the downtrend is in place. So wave two will typically be a much deeper retracement, i.e. it will tend to retrace 50% to 61.8%, but it essentially can retrace up to 99% of wave 1. So long as it doesn't go below the lows of wave 1, it can still be considered a wave 2. So sentiment in a wave 2 is very, very important. Let's go on to wave 3. Wave 3 is usually started by a short squeeze. People start to doubt their positions. They start to think, gosh, you know, maybe it's not going down. What should I do? Maybe I should get out. They're not convinced to buy yet, but news starts to turn slightly positive. The next thing you'll notice is volume starts to accelerate. Any dips in the market become less and less pronounced, and more people start talking about it. Maybe, just maybe, there's a new bull on the horizon. And the last thing to understand is wave 3 will always be, well, wave 3 can never be the shortest. It's usually the longest, and it will tend to extend a lot more than what wave 1 does. Wave 4, where we are right now, weaker hands are usually taking some profits. Remember, mums and dads can't help but take a profit. They're scared of losing open profits. They want to take a profit. That's what they live for, to take a profit. But as we know, taking a small profit will never allow a big profit to unfold. So wave 4 is a very flatter pattern. It tends to be a stalling or a sideways kind of pattern. It's a lot shallower than wave 2, and that's because there's not a great deal of conviction in the selling. Okay, the conviction in the selling is from retail traders as opposed to smart money or institutions. As a result, wave 4 tends to be very, very shallow to sideways, and now that is a key attribute. I want you to write this down. We're going to go and take a look at a chart of CSR, and I want you to remember CSR. When I bring that chart up, I want you to remember this wave 4 rule. The prices tend to stall into sideways or shallow corrective states, because that is a definitive point of Elliott wave to know where you stand within the wave count. A wave 4 tends to retrace very, very shallow, 38.2 to 50% of wave 3. Okay, so a lot more shallow. That's a wave 4 right there. Let's go into the wave 5. And this is the blow-off kind of stage, wave 5. This is late 2006, early 2007. You can't not make money in the stock market. It's easy as jam. All the cab drivers are talking about it. You just got to get in there, buy anything, it'll go up. So that's a wave 5. The crowd's back in. The Holy Grail has been found. Tell everyone it's too easy. Away you go. News is very positive. There's no bad news out there at all. We're going to Dow Jones, that's when you get the books out, Dow Jones 40,000 or whatever, that stupid book that was written back then. Call open interest is usually very, very high. Latecomers join the party. Now, the interesting thing here is volume actually tends to dry up. We tend to get this big flattening top kind of pattern occurring. Momentum tends to slow down significantly, and a lot of the time, especially on individual issues, we tend to get quite significant bearish divergence coming into play. So that's a wave 5. There's two important things to remember with Elliott wave. The first is there are 3 rules. That is it. 3 rules. These rules cannot be broken. Rules 1. Wave 2 cannot retrace 100% of wave 1. In theory, wave 2 can retrace 99.9% of wave 1, but it cannot go below wave 1 low. Usually, typically, wave 2 will trace 50% to 61.8% of wave 1, as we just said in those guidelines there. Wave 2 tends to be a lot more deeper than what wave 4 will be, but we tend to use typical retracements of 50% to 61.8%, but there's no hard and fast rule. As I said, that's typical. So that's rule 1. There's only 3 rules. Rule 2, wave 3 cannot be the shortest wave. So it's very, very important to understand here that when wave 1 occurs, then wave 3 is of equal length to wave 1. The wave 5 cannot be any longer than wave 3. So wave 3 is usually the longest, but it certainly can never be the shortest. Wave 4 cannot overlap the highs made by wave 1 high. Like any charting pattern, Elliott wave is not making the money. The money comes from you creating a positive expectancy from your entry, your initial stop, and how you manage the trade. That's how you make money trading this market, okay? The money is not made because it's a perfect Elliott wave pattern. Same with a triangle or any other pattern like that. So there are 3 core rules with Elliott wave. 1, 2, 3, that is it, bottom line. Where things start getting a little bit more complex and you start getting people doubting and questioning is the guidelines. I suggest a very simple rule of thumb. Keep the guidelines in the back of your head, but always keep it very simple, all right? Complex doesn't create anything more profitable. Complex doesn't make things more probable. Complex just confuses the issue. So keep it simple is what I suggest you do. And when it comes to guidelines, just keep it simple. You notice and when you see this, you'll notice with the Chartist, we tend to keep all the guidelines very similar to every single chart that we have. It might not be perfect, but it's reasonably good all of the time. Impulsive waves, 1, 3, and 5, they tend to be smooth, they tend to be strong. You've got to be able to look at a chart and say, is that a smooth and strong wave? If you have to think about it, well, it's clearly not. So you just got to look at a chart, bang, there it is, or there it's not. If it's smooth and it's strong, it's an impulse. Whether it's 1, 3, or 5, we don't know. But at the end of the day, smooth and strong is an impulse. Corrective waves, 2 and 4, tend to be very, very choppy and very, very messy. That's our guidelines of 1. Let's go to guidelines 2. First of all, keep it simple. Wave 2 tends to be a deeper retracement. It tends to retrace between 50% and 70% of wave 1. It can retrace any amount in theory. But typically, more often than not, 50% to 70%. Wave 4 is a lot shallower and tends to be retraced between 30% and 50%. So the thing to remember here is that there can be idiosyncrasies, there can be changes, but typically wave 2 is deeper and wave 4 is shallower. Again, we're still in the guidelines. Wave 1 and wave 5 tend to be same length. Not all the time, there's nothing perfect, it's not science, but typically waves 1 and 5 tend to equality. The same thing for waves A and C in the corrective legs. Waves A and wave C tend to equality. Not perfectly, not all the time, but a lot of the time. And remember, what we've got to think here is that more often things come to typical levels of retracement or achieve typical patterns, more likely the pattern's going to be correct and we'll move on. So when I talk about typical, I'm talking about in price and in time. What we need here, and at the end of the day, Elliott wave is a discretionary kind of pattern. In other words, it's got to look right, it's got to feel right, it's got to make sense, it's got to smack you between the eyes. If it doesn't, if you've got to go looking for what is a pattern, then it's probably not there. If it smacks you between the eyes, then it's there. And believe me, at the end of tonight, I'm going to show you a couple of very weird charts, and you're going to go, oh my God, there it is. So look and feel, the proportion, both in time and price, has to be there. So waves must be symmetrical in both time and price. Okay, we want nice, smooth waves up and down, fitting all our guidelines within reason and certainly fitting our rules. If the rules aren't met, then the pattern is not there. So proportion is extremely important in both time and price. So let's take a look at this particular chart. Big impulsive movement here. You can see, and this is not a semi-log scale chart, but look at this movement up here. It's impulsive. There is no doubt about it. Very, very strong, very, very clean movement. So that is an impulsive movement. The way this chart is labelled is incorrect. Notice the depth of wave 2 and wave 4. Now remember, one of the guidelines is that wave 2 tends to be the deepest and wave 4 tends to be shallower. It's clearly not the case here. So this is clearly not a proportional chart. So this would be deemed as an incorrect labeling of that particular price action. That would be a more correct labeling of price action. You can see we've got a lot more proportion. It's not perfect, but it's a lot more in proportion to what we had before. So what we've got here is wave 1, 2, big impulse up to 3, and a truncated wave 5, and then an A, B, C, D, or ABC down to whatever it may be below. So that is a correct look at a pattern. Let's just go back. That is incorrect. Wave 4 is way too deep, and that one is correct. Alrighty. In terms of time, what we know is that a corrective movement should be more or less in the same proportion as the prior impulse. So in this particular chart right here, we've got a very nice impulse. 1, 2, 3, 4, 5. It doesn't get any more textbook than that. That is an absolute cracker of an impulse. But notice how long it's taken to make the impulse, to make the ABC down. Now there is definitely an ABC pattern down here, but look at the time taken. It's taken 1, 2, 3, 4, 5, 6 days to make an ABC pattern compared to, what, 10, 30, 40 days to make the prior impulse. So from a time perspective, there is not a great deal of proportion there, not a great deal of symmetry. So it's important that we also get time symmetry. So when we're faced with a situation like this, what we have to expect is that the corrective pattern is only half cooked. There's a lot more to come. And if we move forward in this particular chart, you can see that's exactly what's happened. So we've got a nice impulse, and then we've got this bigger degree ABC pattern. So that in proportion is a lot more symmetrical and a lot cleaner to what we had before. Okay, so that's when we start talking about time analysis. You just look at the chart. How long has it taken to impulse? If it's taken 40 days, one has to assume that it's going to take 25 to 30 days to correct. Okay, if it's taken 40 days to impulse, it can't possibly correct in 6 days. All right, the law of alternation, and this is important. And as I said, at the end of this session, we're going to look at a few charts, and this is going to become very, very important. The law of alternation. The law of alternation is very, very simple. Wave 2 has to be a simple pattern or a complex pattern, and wave 4 has to be the opposite. So if wave 2 is simple, wave 4 has to be complex. If wave 2 is deep, wave 4 has to be shallow. In other words, in every single way, wave 2 and 4 have to differ. You cannot have a simple pattern in wave 2 and expect to see a simple pattern in wave 4. And when I talk about a simple pattern, that's our textbook corrective patterns. And we're going to go through a few textbook corrective patterns, I think 3 or 4. I think there's 18 different kinds of corrective patterns, but there's 3 or 4 textbook ones. All the others become complex. So you can see here this is a simple ABC zigzag pattern, whereas this is just a bloody mess up here. And that's what makes it very, very confusing. But when we're looking at an Elliott wave pattern and we see a simple wave 2, we should expect a complex wave 4, and that's the law of alternation coming into play. The law of alternation also is in the depth of the pattern. So if we see a sharp wave 2, a sharp wave 2 is a zigzag or a deep retracement. That's called a sharp. A sharp wave 2 will mean that usually wave 4 will be a flat pattern or not declining as much as a wave 2 and tend to be more elongated. So you can see here this one tends to move to the right rather than down like a wave 2. Now one thing I will suggest, another guideline, as I said, waves 2s tend to be deep, so they tend to be sharp patterns, whereas wave 4s tend to be flat. And a good giveaway, if you're trying to figure out what the wave count is is you look for these flat patterns, you look for triangles, you look for symmetrical triangles. That's a wave 4. When you find a flat pattern, you've got a wave 4. When you find a deep pattern, you've got a wave 2. Okay, and again, that's part of law of alternation, sharp and flat. If one is flat, the other has to be sharp. If one is sharp, the other has to be flat. What I want to start talking about now is what's known as end-of-wave analysis. Because what I'm doing here is I'm slowly moving from the theoretical analysis part to more, how do we trade off this stuff? You know, it's all good and well having an opinion, but how do you trade off it? Because that's what it's all about. If you can't make a trade, what's the point? What's the point of analyzing a market if you can't do anything with it? So by using what's called end-of-wave analysis, we can start to find points of time where we might be opening ourselves up to an opportunity to initiate some kind of a position. So end-of-wave analysis, here's some that I've thought of. There's probably more. So channeling, overbought, oversold, divergence, volume, and classic chart patterns. And these are all part of what we do here with Elliott Wave. And we're very different here at the Chartist because we use all these techniques. So channeling, we can identify retracement pauses and extensions. And we use this sometimes. Now, channeling is actually incredibly easy to do, but we need a little bit of price action to start with. So if we start with this absolute low down here at wave X, we get a wave 1, we get a wave 2, we get a wave 3. That's where we have to start. Now the whole idea here is to decide and define where wave 4 will terminate. So what we do with channeling is we take a horizontal line or a diagonal line from the top of wave 1 to the top of wave 3, then we parallel that to the low of wave 2, and when price tags that lower channel line, that's when we know wave 4 is in place. Okay, so that's how we use channeling in a bullish environment. We need to see a wave 1, 2, and 3. What we're trying to do is find out when wave 4 is ready to go, and especially if we have a nice ABC on low volume down into that channel line, then we've got a wave 4 and a good buying opportunity. Conversely, we can find out when wave 5 will terminate. So again, what we do here is we take the low of wave 2, the low of wave 4, and we channel, parallel it off the wave 3, and when wave 5, or when prices tag that upper channel boundary, we've probably, more often than not, got a wave 5 in place. Now that's obviously a perfect kind of channeling pattern. If we get some good divergence between this wave 3 and this wave 5, especially when wave 5 hits that upper channel line, then we've got a very high probable reversal point of time for prices to start heading lower again. So that's channeling. So what we do to channel, we try and find the low of wave 4 to trade wave 5 higher, or we try to find the high of wave 5 and trade the market lower. Conversely, we can try and find the end of an ABC correction, and we do the same kind of thing. So what we do is we take the high of wave 5, the high of wave B, we parallel it off the low of wave A, and that will give us a terminal point for wave C. And if we get bullish divergence between A and C, we get a low volume ABC pattern down that hits our typical retracement zone, then potentially we've got a good buying opportunity for the next wave higher. So that's channeling in an ABC correction. We can use it all over the place, and we can use it on smaller time frames as well. So divergence, that's something we use quite a lot at the Chartist, and I think it's one of the most powerful patterns around. A lot of you will be familiar with this. Essentially, divergence is when prices make a secondary high up here. You can see there's a high point right here. Prices make a secondary high, but our divergence oscillator is failing to agree with those highs. You can see prices are moving, or our oscillator is moving down here, and that is called type A bearish divergence and tends to lead to, as a minimum, sideways price action, and then a good result, a complete reversal of form. So when we get type A bearish divergence at a point at a wave 5 high, then potentially we have to be reasonably confident that the trend has completed and a reversal is just around the corner. Now that divergence oscillator, you can read about that in the resource library. It's all discussed there. You should be able to use it on any kind of charting package that you have. It's nothing special. It's a slow stochastic, but I've just removed the percentage D, and what we're seeing there is simply the percentage K. Question from Damien. Good question, Damien. I am a day trader. Are these setups work in all time frames? Absolutely, without a shadow of a doubt, Damien. These are fractals. You will be able to see them in all time frames intraday, so long as there's enough liquidity. Now, in terms of liquidity, well, that's going to depend on the individual stock or the individual index that you're trading. I would say that once you start getting below sort of a 10 or 20-minute chart on ASX stocks, you're going to start to struggle. Maybe the top 20, you can go a little bit lower than a 20-minute chart. Other markets such as the E-mini S&P 500, you can probably go down to a 3-minute chart and you should still be able to see these exact same kind of patterns down there. But really the patterns will be determined by the liquidity. The more liquidity, the better the opportunity will be. Damien, SPY, I don't think so. 2-minute chart, I'd be struggling on a 2-minute chart with a SPY. You might be okay, but I don't think the patterns will be that clear on the lower time frame. As I said, for an E-mini S&P 500, I reckon 3 minutes is about the lowest you want to go down, which puts the SPY probably a little bit out towards a 10-15 minute minimum time frame you want to go to. So that's divergence. There's a bullish type A bullish divergence. We only trade the type A. There are two other types, type B and type C. We do not trade the type B or type C. But type A is like an elastic band. You can see prices moving lower, but our oscillator moving higher, and it tends to whip back. So anyone that follows the power setups, ASX or global power setups, you'll see divergence trades sitting in there in isolation. But when it comes to Elliott wave, they come in very, very handy to telling us, hey, something's going on here. We're seeing the end of a movement. Where's the wave count, and what's going on with that particular wave count? Alrighty, let's move on to overbought, oversold. Again, what I've done here is I've put our divergence oscillator in place. Now, I don't put a great deal of weight onto overbought, oversold on its own accord. But what we've got here is the red line down the bottom. That's our normal daily divergence oscillator. The blue line is something you've never seen on the Chartist before. The blue line is the same oscillator but on a weekly time frame. On a weekly time frame. And when they converge together at an overbought, oversold position, you tend to have quite a significant market reversal point. So if we have a look right here, you can see that the blue line and the red line are overbought. We've got a major high. Here, the red line, or our red divergence oscillator, is oversold, but our blue line is not. We've got a bit of a blip up, but we don't have a significant low point. But down here, you can see both the blue and the red are oversold. We've got a reasonably significant low, so on and so forth. So that's just using our divergence oscillator, extrapolated out onto a weekly time frame as well. So when the two come together in an overbought, oversold, you should pay a little bit more attention. But as I said, in the Chartist, we don't really use overbought, oversold on its own. We like to see other points of confluence, and we'll talk a bit about those as we go on through this presentation. Volume, very, very important. We could do a whole webinar just on volume, extremely important volume. So what we're looking for here is a couple of things. First of all, what's known as background strength in this particular chart. You can see this big increase in volume as prices are coming down. Now what's important to notice here is see how prices are increasing right here. I'm sorry, how volume is increasing right here, yet prices are moving sideways. That means that the selling is being absorbed buyers are stepping up to the market. They're taking on that volume. They're pretty keen to buy it down here, and that is called stopping volume. It's very, very important, and it will mean a significant low point in place. But as we've got it on this particular chart right here, we're calling this background strength. This is the point of price action we're looking at, and this is sitting in the background. So there's no denying there's a lot of buying back here around this 950 area. So look what's happened here. Prices have moved up, and they've come back, and volume has dropped right off. We come back into this low point aligned over here to the left. Volume picks up again. This is called a volume bubble. So what's happening here is buyers are stepping back up into the plate again, and they're pretty keen to buy. What happens? Let's go into the minds of a fund manager. Let's say you're a fund manager, you're managing $1 billion, you're looking for stocks to buy. You've got a group of analysts that work for you, and you say, go and find me good quality stocks and tell me what levels I should buy them at. Now, I don't know what stock this particular stock is right here. I don't know. But at the end of the day, you can clearly see that someone somewhere has said this stock is a good buying opportunity somewhere between $9 and $9.50. So whenever the stock comes down to this region, the buyers step up and start absorbing the volume here and here. So what's happening is the analysts go to their little morning meeting and they say, hey, stock XYZ, gee, if you can buy it for less than $9.50, you're doing very, very well. We think it's great. And so the fund manager, that's what he goes to do. So in this period up here, he stands back. He doesn't buy. He waits for it to come back, and he accumulates every time it comes down. And they leave their footprints in the market. You can see here, that's a footprint. The fact that there's a big volume increase down here, your prices are moving sideways, that's a footprint. We're being told right here that something's going on. And same with here, because we've got the background volume in place. Okay, question from Shane. Should we always expect a retest before the markup? Answer, Shane, is yes. Absolutely, 99% of the time, always look for a retest. This is a retest down here. Okay, so we've got this low point. Markets travel up and come back and retest the lows, confirm the volume. That's a very, very bullish sign. When it doesn't retest, I would be cautious. Okay, so typically, yes, a market should retest a low, and it should do so on low volume. If a market doesn't retest the low, doesn't mean it's not going to keep going up, but I would be cautious about it. So, yes, expect a retest. Interesting patterns going on here. We've got an island reversal down here. Everyone knows what an island reversal is. An island reversal is when we gap down, have a few days, then gap up again. Very, very bullish pattern. So you can see this little 3-day pattern down here is sitting out here all on its own. But have a look at the volume, massive volume bubble down here. Prices are falling, 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 and then it's picked up by buyers stepping up to the plate and picking up this particular stock, whatever it may be. So we've got a combination of many patterns going on. We've got the volume bubble, we've got the island reversal, and we've got a head and shoulders reversal pattern. Very, very bullish. And by the looks of it, prices have kicked on out of that pattern. So again, 5 waves down, 1, 2, 3, 4, 5, head and shoulders reversal, A, B, C. This is just an absolute cracker buying opportunity down here. Basis not just an Elliott wave. You've got the A, B, C, you've got the left shoulder, the right shoulder, you've got the island reversal backing it up, and you've also got this massive volume. So when we get confluence of all these different patterns sitting in here together, that's when you've got a great opportunity to line it all up. All right, now I said right at the start of the session, one of the most important things is if you can identify a correction specifically, if you can identify the terminal point of a correction and understand how a correction will unfold, then you're in a much better position to trade the following impulse. Remember, slide number 1 was impulse correction. Impulse correction, 1 step forward, 2 steps back. 1 step forward, 1 step back. That's what we're trying to do here. If we can identify the correction, therefore we're going to be in a good position to trade the next impulse, and they're the waves we want to trade. So what we're going to do here is take a look at 3 or 4 of the core common corrections. These are textbook corrections. There are 13, I think, 13 or 18 different kinds of corrections. Obviously, beyond this 4, they start becoming a lot more complex. We're not going to go into those complex ones. So the first one we want to look at is a simple zigzag. Now, when we're looking at these, I want you to keep them in mind, because when we go to the charts at the end of this session, you're going to be seeing these. You're going to be seeing these left, right, and center. So a simple zigzag is pretty straightforward. We have a dip, we have a small rally, and then we have a secondary dip. The secondary dip into wave C must go below wave A, and wave B should not go above the terminal point up the top here. So zigzag rules, or guidelines I should actually call them. Wave A is an impulse, okay? It should contain 5 waves, but wave A and wave C are always impulsive waves. They will tend to be quite clean and aggressive. You may not be able to see the 5 waves on an end-of-day chart. You may need to go down to an intraday chart to see those. Wave B will tend to retrace 50% of wave A, and wave B shouldn't retrace any more than 75% of wave A if it's to remain a zigzag. If we do go above 75% of wave A, chances are the pattern is morphing into something else, which we'll get to next. So for a zigzag to be in place, wave B cannot retrace more than 75% of wave A. Now remember, wave B is also a corrective wave, so wave B should always be 3 waves. It may not be 3 waves on an end of day chart. It will probably be 3 waves on an intraday chart. Wave C tends to be the same length as wave A, and wave C will always surpass the lows made by wave A. So let's take a look right here. Absolute cracker, perfect example, textbook zigzag pattern. We've got 5 waves up, wave A comes down, B, you can see 3 waves up to B. That's a 50% retracement, that blue line, and again we come down. Note as well that we've stopped almost in between the 50% and 61.8% area, and have a look, what do we have there? That is a blow-off low. So that's a classic chart pattern, and it's coming at the end of an ABC pattern. It's coming at a typical retracement zone, and it's coming at a time point that is very symmetrical to the prior impulse. And these are the kind of things we've got to keep an eye out for, because that is your absolute perfect trading opportunity for the next wave higher. Here is another one, slightly more compact, but we've got 5 waves up, A, B, C back down again. It tags the 61.8, so we've come back down into that typical retracement zone. And again, you've got a situation where the stock is gap lower and closed quite high. It'd be interesting to see what the volume was on that particular day, and off we go again. A flat pattern is more of a sideways zigzag pattern. So what we have is wave A comes down, wave B tends to go all the way back up and tags the high, so we've got a double top pattern in place, and then wave C comes back down, equaling the lows of wave A. A question here from Brian. With blow-off lows, any significance in the closing price? Absolutely, Brian. A blow-off low, we have to have a high close. It's not a blow-off low unless we have a high close. So if we have a high close, let's just go back up. You can see we've got a very high close. There's the close there. So big wide-ranging bar down and a nice high close. If we take a closer look at the flat rules, wave A and wave B will both tend to contain 3 waves. Wave C can sometimes contain 5 waves. Wave B will retrace 100% of wave A, or very close to it. Wave C, as I said, just contains 5 waves. You may need to look on an intraday chart to see those 5 waves. And wave C will terminate at or just below the lows made of wave A. So if we take a look right here, the very, very tight one here, A, B, C, you can see wave C just below, ever so slightly below the wave A lows. But more or less what I'm pointing out here, it's a sideways kind of movement. That's what's important. It's not a declining movement like what we see with a zigzag pattern. Here's another one, not quite there, it's more of a triangular pattern I guess, but it gives you that kind of idea of what I'm talking about. It's a flatter sideways pattern. Retracement is a lot shallower than what you would normally expect, and that's what distinguishes a flat pattern from a zigzag. Zigzags are deeper patterns, whereas flats are shallower patterns. Another one, that's a perfect example right there. Nice and flat. Wave B goes right up to that terminal point. Wave C comes just below the wave A by a small margin. Nice high close there on high volume. Looks like a very, very bullish proposition right there to me. Running flats and flats, as I said, are good trading patterns. Very slight distinction between the two, and that is really wave B will run above that terminal point right here. So here's your terminal point. Wave A comes down. Wave B runs above, and wave C will tend to come below by a very small margin. And so what you have here is this area down here becomes a very, very good buying point because if it is a good running flat pattern, prices shouldn't go too far below that wave A. So if you get some good confluence down here just below wave A, it becomes a very, very good buying point. So the rules of a running flat, wave B will retrace greater than 100% of wave A. In other words, wave B will go above the high of the prior terminal point. Wave C will tend to contain 5 waves down. You might have to see them on an intraday chart. And wave C will terminate at or just surpass the lows made by wave A. But the most important thing is this wave B goes up above into new high territory. So if we have a look right here, you can see potentially we've got a wave 1, A, B goes above, and 2 comes back, and away we go higher again. And that's the defining factor with a running flat as opposed to a flat pattern. Again, wave 3, down, up to new high, and back down again, and off we go up to wave 5. So that's a running flat. Here's a flat pattern. You can see it doesn't do that. It's more sideways. These two highs, we've got that double top in place, whereas here it's a secondary high in place. Lastly, we're going to look at a triangle. A triangle will only ever appear in the wave 4 position. A triangle can never appear in the wave 2 position. A triangle can only appear in the wave 4. If you see a triangle on a chart, and as I said, watch out for CSR when we bring it up. When you see a triangle in a chart, it has to be a wave 4 or a wave B. It cannot be a wave 2. So a triangle has 5 internal points. Wave A is always against the current trend. B, C, D, and E. They're the 5 internal points, and they all must be inside each other. So if wave C is outside of wave A, it cannot be a triangle. Wave D cannot be outside of wave B, and wave E cannot be outside of wave C. It has to be a coiling pattern. So a triangle has 5 internal waves. Usually all internal waves contain 3 individual waves. They may need to be seen on an intraday chart, and it always has to coil. And here is an absolute classic example of a triangle. So we've got this movement up, A, B, C, D, and E, break out to the upside, and away you go. I'm going to play a little trick here for you. This is how I want you to learn how to start reading wave counts, because this will make life a lot easier. So this is QBE. This is a weekly chart of QBE. What I'm going to do here is I'm going to put in what's called a zigzag indicator. A lot of chart packages have a zigzag indicator, and it's very useful to getting a feel of what waves are like. Now, this particular weekly one, I'm going to set to 20%. 20%, Nick, not 22, 20%. Basically, what happens here, when we have a move from an absolute low to an absolute high that exceeds 20%, we'll draw a line. If the move from the absolute low to the absolute high is 15%, there will be no line drawn. So what we're doing here, for those of you that have read adaptive analysis, is basically we are putting families of percentage movements all together, and what that enables us to do is see waves of themselves in the same time frames. So when we see waves in the 20%, they all belong to the same family. If we drop it down to 10% and see all those waves, well, they all belong in the same family. Does everyone understand what I'm talking about here? You'll see it immediately when I do this. All right, so let's just click that button, and let's just get rid of that. All right, now you can probably see on your screen here a series of waves. I want you to start back here in early or late 1992 at this absolute low point down here. I want you to watch carefully. Impulse, wave 1. Decline, wave 2. Let's think of a retracement. Remember, what's the rule with wave 2? Should retrace 50 to 61.8%. So let's just get rid of the 38.2. Look at that, smack bang, 61.8% right there. So, wave 1, wave 2. What's the rule with wave 3? It can never be the shortest, and it's usually the longest. Wave 3. Put in a wave 3. What happens with a wave 4? Remember, wave 4s tend to be shallow. Wave 4s tend to be shallow, triangular kind of shape. So if we put in our Fibonacci retracements again, up to, we take out the 61.8%. Remember, a wave 4 will tend to retrace 38.2% to 50%. There's our 38.2%, that blue line right there. You can see it's tagged it very, very nicely. So we've got a wave 4 in place, and then potentially up to a wave 5. So what are we going to label that? Well, that will be a new wave 1. And all of a sudden, we start all over again. That impulse goes up. Typical retracement is between 50% and 61.8%. Look at that. We come down. We go through, just go through the typical retracement. So we can label that a wave 2. And off we go again. So what's happening right here? We've got a wave 1, we've got a wave 2, interesting one going on up here, isn't it? Wave 3 perhaps. And it's at this situation we've got to think about what's going on in the broader market. We potentially could still be in a wave 4 right here, couldn't we? Because wave 1, the highs of wave 1 have not been overlapped. These are the rules. But we're certainly impulsing. We're certainly correcting. So at this stage, everything continues to look very, very bullish for QBE from a weekly perspective. But the question is, are we going to get a bit more of a retracement? Where are we going with this particular pattern? So you can see from this kind of style of chart, it becomes a lot easier to start looking at wave counts. Let's bring up CSR. That's a daily chart of CSR. All right, let's just answer the question here. Nick, what happened to the ABC that normally follows the wave 5s, which you just labelled as a bigger degree wave 1? Okay, well, as I said, what we're doing there, Brian, is we're just looking at the broad terms. If I had actually extrapolated that chart to a normal bar chart, you would have had an ABC pattern down, but the situation was that the wave B wouldn't have been more than 20%, okay, because our zigzag indicator was set to 20%. What I'll do in the next chart is actually bring the chart up so you can see it. That will make life a lot easier and a lot more simpler to see. So let's put in our percent indicator, our zigzag. What I tend to do with a zigzag indicator, because every stock is of a different volatility, I usually set it default for daily charts to 12.5%. 12.5% is reasonably good for the top 50, but the further you go out the curve, the more you've got to set that because, or the wider you've got to set that because the volatility increases. There's no point having a look at a 20-cent stock with a 12.5% wave percent because the volatility of that stock is too much. So what we're going to be looking at is some bigger names tonight, and we're going to be sticking to 12.5%. But it is not one stock suit or 1% suits all stocks in any way, shape, or form. All right, it's more important to match the wave percent to the individual volatility of the stock. If there's too many waves going on, you've got to reset it. Okay, so this is CSR. This is a daily chart, and let's extend it back here to March 2009. And we've got this set to 12.5%. Now, if we just have a look here, we've got a major low down here, but take a look at that. Wave 1, Wave 2. You can see there's a blip up. I really can't. I'll try and bring it up there so you can see it a little bit. There it is there. A little bit hard to see. But it is there. You can see we've got a move up, a move down, Wave 1, 2. We've got an impulse into Wave 3. We've got a triangle into Wave 4. Remember our law of alternation. Look how deep this wave is right here. And up to Wave 5. Now that may be a Wave 1 or A. I don't know. But look what is happening from that point of view. We've got this sideways choppy price action. We've got strong impulsive movement up here and choppy price action down here. So it may well be that we've got a Wave A, Wave B, we might have a Wave C in place here, I don't know. But what's important here from a trading perspective is we're stuck in this sideways range right here. Now look at the time. Look at the time it's taken to move up to this point and the time taken to move along in our corrective move. You can see it's reasonably well balanced. Okay, the symmetry up here, along here. What would you do in this situation? Well, regardless of the wave count, two things really stand out to me on this chart. The first thing to stand out is we've got a definitive 5-wave impulse. We've got a definitive corrective movement, choppy sideways price action. So one has to argue that we're going to get this kind of movement occur again at some stage into the future. It's just a matter of when. And when the thing, well, when it's going to come is when it breaks through the upper side here. So when CSR breaks through 220, you can bet your bottom dollar that we're getting the next impulse going higher, unless we get more definitive action in the corrective movement. But as it stands right here, sideways, shallow sideways, let's have a look at a Fibonacci on that. It hasn't even tagged the 38.2% retracement. So it's a very shallow retracement. It's not typical, but the fact that it's moved sideways for so long makes it very, very bullish. So it's just a matter of waiting for CSR to break up through the upside, 220, and away you go. And you would expect another movement similar to what we're seeing right here. And that's what that's. So it's a $1.40 move. You would anticipate 320, 340 to the upside here in CSR eventually. Okay, so that's the chart in there. Slightly different, not as clear as what we had before. And that's why I'm suggesting that to learn the wave counts, sometimes it's a lot easier to do it like that. Let's have a look at another one. Again, a very similar kind of pattern right here with Bank of Queensland. We've got a movement up and back. Is that a 1, 2, 3, 4, 5? Well, remember one of the rules is that wave 3 can't be the shortest, so let's measure that one. Put it there. Well, no, that's okay. That's fine. In fact, I've got a semi-log scale chart on here. That's not helping anyone. So really, again, what we can kind of see here is a 1, 2, 3, 4, 5. If we measure the depth of wave 4, you can see it's pretty shallow. It hasn't tagged the 38.2%, which means it's shallow. Wave 2, on the other hand, let's see how deep that is. You can see it's tagged to 61.8, so it's deep. So you get a shallow wave 4, you get a deep wave 2. And you've got this sideways price action going on right here. So potentially what we've got going on is an A, a B, potentially a wave C here. It might be a new wave 1 up there, 1 or A, 2 or B. And you can see exactly how I'm building these charts. What's the retracement of that bigger move up? Tag 50%. Remember the rule of thumb. is that a wave 2 or B will tend to retrace 50% to 61.8% of the prior wave, and we're in that zone right there. So Bank of Queensland, we may have a good low point in place. We've got a question here. How would you estimate a good buy time for CSR? Would you wait for a breakout of the wave B before placing a trade, for example? Yes, Vanessa, I would. I would wait for a breakout of that range that we had in place there for CSR. I can bring that chart back up again if you want to take a quick look at that again. CSR. You've got this sideways range going on here. The safest bet, not the only bet, would be to wait for a breakout of that range before you jumped on board. If we saw some good volume or confluence down at these lower levels, then potentially you could put in some smaller position down here, maybe half your position, and then add to the position as prices break out up through here. That's always a possibility. There's no hard and fast rule for doing this. It's whatever you're comfortable with, but certainly confirmation would be a break up through 220. You wouldn't want to be sitting back on your position. You'd want to have a full position on up when we go through 220. Do you ever buy the pullback rather than wait for the breakout, asks Damien? Yeah, well, that's exactly what I was talking about. If you get good volume confluence down here, then yes, you can buy half the position down here, then add the other half as we break up for confirmation. So you can certainly do that. That's one thing we recommend in the Chartist a lot of the time. Wow. What can I say about that chart? Pretty simple, right? 1, 2, 3. What kind of a pattern is this one? A, B, C. What kind of a pattern is that right there, everybody? A, B runs above the terminal point. C runs below wave A, running flat. Absolutely right. That's a perfect running flat pattern right there. It does not get any better than that. Extremely bullish looking pattern in my view. There is an argument, and perhaps it's an argument we have used in the Chartist, that this was a truncated wave 5. And we've used that argument because potentially of the broader market view. Remember, what we try and do with the broader market view is try and apply it to the individual stocks as well. We try and align them all up. But looking at this, if I was to look at this particular chart without looking at the broader market view, that to me is a bullish chart. It suggests that CBA is going to travel higher. And again, using the analogy that wave 1 and 5 tend towards equality, what we've got is a running flat. The alternate scenario, we do have a wave 5 here and we're seeing a bigger corrective movement. That is CBA. You can see it's clear as day on that particular chart. What happens if we go back here a little bit more? Look at this, off the late 2007 highs. What can you see? A, B, C. Look at wave B. Look at this area through here. What's in there? Choppy, choppy, choppy price action. Wave B, remember wave B is a corrective wave. Wave A and wave C are impulsive. Wave B, corrective, choppy. A, B, C down. Okay, A, B, C down must be followed by a new impulse, and that's what we're seeing right now. And looks like CBA is going to go to new highs by my view anyway. Question from Michael, do you use log charts for your initial analysis? Yes, I always use log charts. There's really no reason to use semi-log scale, Michael, unless you've got some extreme price action. I'm just doing it on this particular chart so I could see these lower points a little bit better than what you normally could. But yeah, look, rarely do I use semi-log scale charts. Brambles off this high. 1, 2, 3, 4, 5. Not particularly textbook, but look at this. Big blow-off situation right here. Look at that. Big, wide-ranging bars, gaps, bad news event going on here. Look at this massive volume. People just getting out. And then look what happens. We go down to a secondary low down here. Look at the volume. There is no volume this time around. Absolutely no volume whatsoever. All the selling's been done. People are out. They're out. We've had enough. This stock has dropped 20%, and they're out. A secondary test of the low. Let's just put our divergence. There's got to be bullish divergence right there, surely. Oh, there's not, but gee. That's the kind of situation you'd expect bullish divergence. So a secondary test down to the low, big high close, but look, there's absolutely no volume associated with that high close on that bar right there. And what does that mean? What does a high close mean with no volume? It means there's no sellers. The sellers are done. The sellers are out here. Those that wanted to get out, they're out. Here, it's little mums and dads capitulating, but really there's a lot of good buying going on. Not strong buying. You don't need strong buying because there's not a great deal of selling. It hasn't taken a lot of effort to close the stock at its high because there's not a great deal of selling going on. And off we go to the upside. So a big blow-off low situation. Oh, gee, it would be nice to have some bullish divergence going on down there, that's for sure. Now look what's going on the upside here. What have we got? We've got a situation of overlap. Okay, so it's not a new impulse going up here. We've got overlapping price action. So we've got a bullish correction movement going on off of those lows right there. And sometimes, and you can see it's failed, prices are rolled over and gone back down again. So that was your giveaway right there when prices overlapped. Okay, that's your giveaway that it's a corrective move and not a new bullish move, that overlapping price action right there. So essentially what we've got here is a wave A, wave B, and a wave C. And it looks like we're going back down again in an ABC pattern to the downside once more. So if we just squash that up, okay, so ABC back down again. So the giveaway on this particular movement was all the way back here, that this was not going to be a sustainable bull trend. Bigger picture, and sometimes this is when it's good to go to the weekly chart. Okay, if we go extend out to the weekly chart now, it becomes reasonably obvious. Let's just get rid of, let's turn that into white. Okay, it becomes reasonably obvious that we've got choppy price action going on here, don't we? So we could almost label that in itself a, this would be a B down here. And then we would anticipate that wave C will start to push higher again. So there's upside potential to be had here, but this choppy overlapping price action suggests it's an ongoing corrective movement rather than a new impulse higher. So that's all the charts I have scheduled. Now we've got a couple of questions coming through to look at a few other charts. A question here from Ron straight away with Brambles. Does wave C have to equal wave A in length and time? Yes. And that will give us this perfect wave A, B, C kind of pattern, and then we would anticipate prices to head lower again. All right, does that make sense? So we take the distance of wave A, the time of wave A, and we add it on to the low of wave B, and it's our target point right at that corner up there, which is March 2011, somewhere just below the $10 mark. Make sense? So that's how we do it. It's a very simplistic kind of time analysis, but that's essentially meaning we would get a wave equality with regard to time and price from Brambles, assuming we're wrong. Now, the other thing we have to understand here, the prices can't go below these lows. If prices go below those lows, we're absolutely dead set wrong. They can't do that. So, from a risk-reward perspective, we know the buying in this general region is a low-risk opportunity because we would have a stop below this low right here. Because if it does go below there, we're wrong. If you do have any further questions, drop me an email. I'll try and answer them as best I can. Otherwise, remember, we look at all this stuff in the chart analysis every single night. Thanks for your time. Have a good week, and we'll see you again very, very shortly. Thank you.